Welcome to the capital market session. My name is Rolf Johan Ringdal. I'm a partner with the law firm BAHR in Oslo. And it's my privilege to introduce the panel to you with Jim Cirenza sitting next to me, who is the managing director of DNB Markets Inc. Next to him, Rikard Vabo, who is the managing director of corporate finance with Fearnley Securities. And at the far end, Mavrinac, managing director and global head of Maritime investments at Jefferies. Sharp minds in the audience who were here last year may recall that the three gentlemen formed a very good panel on the same subject last year. If we were to supplement the panel this year, it would have been nice to see a bright female from Asia who could supplement the European and American stance. And having listened to the Hong Kong presentation earlier on, I think there would have been a lot to learn from the activity in the Asian capital markets. But I suspect we'll have a focus on the US and European markets in this session. And the very interesting discussions that these panelists held last year ended, as some of you may remember, on a quite positive note. It was stated that the fundamentals in shipping were very good, that the stock price of shipping companies was unreasonably low, and there was a lot to invest in. And the conclusion was that we've just left the starting block. That's 12 months ago, and in those 12 months, the shipping index has declined by approximately 20%. So, Richard, what went wrong?
Well, a lot of things went wrong. It was probably 12 months early with that statement. We had that same seminar in September last year. We have been off the bottom in May, June. Rates were recovering. Market balances looked better. Oil prices were hitting $80. Then suddenly came October and S&P were down 20%. Oil prices collapsed to $50. The performance of all fund managers around the world, even though, independent of you owning shipping or Amazon, were wiped out. So it was a sharp correction in the market, and energy cyclicals, obviously in that environment, is with a high beta segments, it's a huge impact that we saw across the board, even though the fundamentals looked reasonably well. And then came some new investors in early January, and then suddenly a dam collapsed, and a new disaster was overshipping, and that was the end for many investors participating in this industry. In fact, and I believe it resulted in a huge risk aversion among a lot of investors out there, which have continued throughout the year, and we are still struggling with that. We're seeing several industries, Vabo, for example, generating 25-30% return cash on cash today. Shares are trading 20, 30, 40% below net asset value. The question didn't include whether or not we continue to be at the starting block or the next 12 months, but I guess we'll get into...
we'll look into the crystal ball a little later on, but it is an exercise associated with some risk in that you can be tested 10, 12 months from now. Doug, would you like to comment in addition to what Richard just said?
Yeah, I would echo a lot of what Rikard mentioned. It's hard to kind of find one silver bullet when you're talking about so many various sectors. So, for example, he referenced the dam collapse earlier this year. I mean, that had a dramatic impact on the dry bulk shipping market, which was it's one of those unforeseeable events. Things like trade war escalations, macro concerns that come about as a result of trade rhetoric, and you start seeing, and you heard the products tanker panel talking about the backwardation and certain price strips, which then encourages destocking. So all those sorts of things that aren't included in a supply-demand model, I think played a large role in why the market has disappointed over the last 12 months. That being said, looking forward, once again, when you've heard other guys talking about order books being at record lows and the disruption from IMO 2020 and the new trade routes that are developing, once again, the outlook looks promising, but you always have to be mindful for those exogenous events that you just can't foresee.
So these unforeseen developments, Jim, do they result in more activity within the ECM market or more in the DCM market, if we just stick for a brief period to the past 12 months?
Can you hear me, first of all? Good, because my light's not lit. DCM1, the high-yield markets continue to function. We only had a stretch in the fourth quarter where the high-yield bond curve blew out relative to the Treasury curve during that material and energy meltdown in the fourth quarter. But otherwise, the high-yield markets continue to function. In the last year and a half, we've been involved in 15 shipping DCM bond transactions, 8 in Norway, 7 in the U.S., and thanks to the fact that a big part of the world has negative yields, at least shipping companies can often manage to get a single-digit coupon in this environment. The equity side of the business, it's been a drought. And we've been involved in a couple of share buybacks. We've been involved in a couple of ATM programs. We've been involved in a couple of issues. You don't pay a lot of bills that way.
No.
You look at the S&P. In the last 10 years, it's up fourfold. You look at the shipping market in the last 10 years, I think it's down 70-something%.
Right. So, Richard, in the coming 12 months, do you expect the ECM or the DCM market to be the more attractive or the more active?
Well, I guess the key drivers will be fundamentals, cash yields, liquidity. Quality companies will be able to do transactions. Without a doubt, in the near term, there will be more activity on the credit side. There is underlying significant interest in the sector. However, due to the massive impact on fund performance and risk aversion, as we discussed in the introduction, I think the interest for the credit side reflects the risk aversion for many investors, and they want to play the shipping from a credit point of view and not the equity point of view. It still offers a lot of value. As far as we are aware, there is within the shipping and oil service sector around 15 transactions being discussed at various stages today of around $2.2 billion, which will come probably in the second half and maybe in the first half of next year, depending on market development. But I believe the next at least 6 months will primarily be credit focused.
Well, Doug, do you think that this might be a time when convertibles and hybrid products will come to attract more interest?
Yes, Rolf, I do, and I'm glad that you asked that question because I think a convertible instrument is an underappreciated instrument within the shipping markets. Conceptually, if you're a company and your stock is trading at 85 or 90% of net asset value and you see an acquisition opportunity coming up, you can't utilize your equity because you would be diluting yourself. However, the convertible provides you the opportunity to raise that capital, and if it converts to equity, if you're trading at 85 or 90%, if you have a 30% conversion premium, for example, you'll be raising equity above net asset value if it converts. If it doesn't, you're sitting there with 3-something%, 4-something% paper, which, relative to, what companies are able to achieve in the high yield markets is quite attractive. So I think conceptually, the convertible instrument does make a lot of sense. And practically, there's been 2 convertible bond issuances in the U.S. over the last year and a half, Ship Finance April of last year, Eagle over the summer. When you compare that against the equity raises in the U.S., the successful equity raises, similar number, similar size. So It is starting to be used. A little bit of good news and bad news, though. The good news is we talk to our convert desk practically daily, and they tell us keep sending us ideas because the convert market is full of healthcare and technology. They're dying for new ideas. That's the good news. The bad news is that not all shipping companies can utilize the convert market because you need a certain degree of liquidity, and if you have a big dividend that you're paying, it makes it more difficult for the hedge funds to short the underlying. So there are ways around each of those, but nonetheless, I think the combination of being able to raise, equity if it converts above net asset value, and in the meantime borrowing at 3 or 4%, there are worse ways to raise capital.
We heard a lot about ESG from different perspectives in previous sessions, and I think we may revisit that a bit later on even here, but we learned in one of the earlier sessions that 40% of cargo in transport is transportation of fossil products. And there is generally, I guess, these days a critical eye on coal and crude oil as in an environmental perspective. So, Rikard, how does this investor sentiment on energy affect shipping and the interest in shipping?
I guess the ESG is becoming increasingly important to the sectors and to the energy sector. Shipping is obviously associated with fossil fuels, and we have seen investors increasing their risk and risk premium on these kind of sectors. I guess you cannot substitute seaborne transportation, so there will be investors coming into the space if the return rate requirement is high enough. And if we look at some interesting surveys that has been taken, if you look 2010 until today, the internal rate of requirement required from investors in projects for renewables were more or less the same, maybe slightly down. For fossil fuels, is up dramatically. For coal projects in 2010, investors required 15%. Last year, they did the same survey, they required 40%, up 25%. Same is for oil projects, various projects, whether or not it's shale oil, 2 to 5% increase from the last 8 years. So there is a risk premium, which I think we need to get used to. It was also mentioned by Jeff earlier in Financial Times. There was an article about investors complying with the Paris Agreement in 2014. That was around 80 funds, accounting for $52 billion in asset under management. This time around, according to the article, it was 1,111 billion. They will not invest in fossil fuels. Whether or not that impacts shipping to a large extent, remains to be seen, but at the margin, of course. And I guess in Royal Dutch Shell's annual report, they state that, what do they call it? The investment campaigns from investors is a major risk for the company. So we heard it earlier on in the financing panel that the banks are also taking this position and to provide financing. So I think it has had a huge impact on the fossil fuel energy space, indirectly on the shipping space as well. And I think we will see some higher rate IRR requirements from investors, and we need to get used to it, at least for now.
Doug, do you think that the shipping industry will qualify relative to green financing and the new green bond products that are being marketed?
I think it kind of depends. Kind of maybe some firsthand reconnaissance that we have is, in addition to some of the capital markets activities that we've been pursuing, we talk with owners about private placement opportunities and requirements. And I would say that in certain sectors, so getting back to, it's hard to kind of group all the sectors together, but like LNG, for example, we do see some green funds that are interested in investing in LNG. And now, maybe they either,
LNG.
Yes,
Yeah.
correct, yes.
Right.
Either they like the outlook for the sector, or there's a misbalance in what they're able to invest in and their needs to invest. But we have seen and talked to some of those funds desiring to invest in LNG shipping.
One noticeable trait, I guess, during the past 12 months since you were last on the panel is that many of the international investment banks have been scaling down their focus on the shipping segment. Analysts are retreating from the space. Fewer companies have analysts. And this is, I guess, Jim, a quite disturbing and worrying development. What's your thoughts on that?
First of all, someone left the barn door open, and we're not going to get all the animals back in. So this is a trend that we haven't seen the end of.
So you think it's not something which is temporary, reflecting the current market. It's long term.
I think it's long term, and it's not just on the sell side. It's also on the buy side. You think about, so let's first of all, we had Dorian up here presenting earlier. Dorian is the only U.S.-listed LPG stock. It has 7 analysts covering that company today. Only one of those analysts is a U.S. analyst. BW LPG and Avance have 14 analysts covering the company, stocks listed in Norway. I think it's a problem for the U.S. capital markets because the U.S. capital markets were the most attractive for more than one reason, not just because you had the biggest investor base, but also because you had an active community in shipping and offshore, both on the buy side and the sell side, which has now been squeezed very, very hard. And the number of major firms that have pulled out of the space in the last 3 months is concerning because you think about the education process it takes to get someone interested in making an investment, particularly if that investment doesn't fall into one of their fast-growing categories like ESG. So you take ESG, if you're a technology company or a healthcare company or a telecom company, great, you're a big overweight. If you touch energy, you're in trouble. It could be worse, it could be utility. So you're in a space which has been under pressure for a decade. Active assets under management have shrunk. They've had redemptions every year, ETFs have grown every year, and now the only thing that's working for them in the last couple of years is these ESG funds, but shipping's not part of it. So to get fund managers to focus on this business, to keep shipping relevant in the United States, this loss of analysts and loss of investment bankers is a concern.
Doug?
Yeah, I would add to that and echo what Jim mentioned. I mean, as a former analyst, both Rikard and I, that analyst role serves a critical function. You're the guy that's going on your morning call talking to the institutional sales force. Those 100 people are making 100 calls on their own. I mean, so, they're your megaphones, but you're the guy originating the message. Once a firm loses coverage or drops coverage of the sector, then they're not hearing on a weekly basis what's going on in the crude oil tanker market. They're not hearing what's going on in the dry bulk market. And, it was already hard enough and you'd have to beat up on your sales guys to make your calls. Now there's no one making the calls. So the next time, an issuer goes to the market, they don't know where the bodies are buried because shipping was already a sector that has lost money for the last 10 years, so it's already an uphill battle. But whenever that inevitable time comes where the window is more open for more companies to issue equity, it's going to be a bit more of a challenge than it has been once you lose the pulse of that investor base. Some firms, like ours, that are on this panel remain committed to the space. But I'm speaking more in general that if I'm a company or an issuer, the loss of the analysts, it does create some challenges.
Would you like to comment on that, Rikard? Or it might suggest then, it's clearly to have the largest financial market in the world lose interest in shipping, that sounds like a major problem. And that might possibly affect the geography of things, the choice of listing venue, where are things going to happen in the future? And I mean, you're based in Oslo, even though you have a subsidiary in New York. You feel the same concerns and developments that Jim and Doug have raised?
Not really. At least now they will come back, and they will come back quickly and hard. It has happened several times before. You know, when things are moving in the right direction, they suddenly hire a team again. And I think most of the Norwegian investment banks that are highly active in the space have also a large or larger or smaller presence in the US, are actively discussing with US investors. So alongside with companies like Jefferies and DNB, and I think they are continuing to marketing the sector. The sector is really small. If you combine all companies, market caps of shipping companies around the world, everything from Maersk in Denmark to Mitsui OSK in Japan to Frontline in the US to Golden Ocean in Norway, you come to $170–180 billion. That's, you know, that's all global market cap of shipping. That's 0.2% or 0.15% of the total capitalization of US shares alone. It's nothing really. So it's yeah, probably a bit less. But I think shipping will come back. Right now it has struggled with weak earnings, challenging macro environment, and you know, cyclical business, commodity-related business are not the prioritized sectors in a very unstable and uncertain macro environment. For us in Fearnley, we think it's a great opportunity. So we're trying to take advantage of the few companies that are, you know, shut down their shipping coverage.
Yeah. So Jim, where do you think, with this sort of bleak background picture as regards US investment banks, where do you think the bulk of the activity will take place going forward in the next 12 months?
I think there are a couple sectors within shipping that will work well with the capital markets. I think the fundamentals around the product tanker and crude tanker space, which were up here earlier, and I won't get into a long dissertation of our views around those sectors, but there are enough people that will see opportunities out of this disruption that's coming up. It certainly does make a case for centers like Norway to get more influence. We've had a number of situations in the last 2 years where we've been able to list something in Norway that we have not been able to list in the US. And so as long as Norway is in this sort of privileged position of having a good number of banks, investment banks, analysts, and a reasonable capital market, and a reasonably well-educated investor base as well, places like Norway will benefit. I don't think people will avoid the US. It's still the most interesting investor base to have. It's just going to be a lot more difficult to access it.
So the old, well, what was frequent some years ago, where you had the new company doing a private placement being listed on the NOTC in Oslo, they're staying there for a year and a half, and then trying to go on to New York. That's perhaps not the model of the future, do you think?
Oh, I doubt it is.
You doubt it is, yeah. Doug?
Well, I was just going to respond to your question a bit ago in two ways. You know, the outlook that I provided that was, you know, a negative result of the analysts leaving was more from the company or the issuer standpoint. From the surviving company standpoint, it's phenomenal. You know, right now those investors are still there. Randy, our analyst, there's 50-something analysts at Jefferies that cover all sectors. He's probably in the top 5 right now in terms of investor interactions over the last month. He does a great job, but also, you know, the funnel is funneling towards the surviving firms. So those guys are still there, but it's just representative of how small the market cap is, yet he's still in the top 5 in terms of overall interactions. The other thing is that, the U.S. market is still so big, still so deep. So, when we look at Norway versus U.S., Norway is very active, and for a certain size, it's a very good location. But when we look at a couple of the capital markets transactions that we've been involved in over the last 12 months, the size of the transactions required U.S. involvement. It wouldn't have been successfully completed without those U.S. investors.
Yeah, and then we have all of Asia on top of that, of course, where it's apparently very active. But back to the crystal ball. I mean, we have 2 minutes and 40 seconds left. We heard what the crystal ball last year, how that ended. But I'll ask you this time, each one of you, which are the segments that look promising? What's hot and what is not? Starting with you, Doug, what do you think?
I personally like the outlook for the refined products tanker market. A lot of the shipping sectors are likely to benefit from the disruption on the supply side of scrubber installations, et cetera, et cetera. However, the products tanker market also has the added benefit of benefiting from new trade patterns developing because of fuel availability and dislocation. So I tend to prefer the products market.
And which one will you pick, Rikard?
Do you have to pick one?
Well, you can pick two.
Pick a sector.
Yeah.
We are optimistic on shipping. I believe there's opportunities in dry bulk, tankers, LPG, LNG. I believe the opportunities is upwards in terms of pricing. On our estimates, you have 20 to 30% return cash on cash for 2020. And I believe you have started to see impacts of IMO 2020. If the world is not collapsing, which is a big uncertainty, of course, if more demand is continuing to grow moderately, I believe we will have a very exciting 2020.
And Jim, what's your pick?
I'll take product first and crude second, but product with more refined products. 10 years ago, about 15% of all product touched the water. Now we're somewhere in the low 20s. And you think about where the refinery additions have been made, roughly half of them are not going to be the absorbers of that additional product that gets refined. So by definition, I believe more will touch the water. And if you need more compliant fuels, then you have to put more crude oil into the system. So I do think that the crude tanker segment gets some benefit from that as well.
So maybe we just left the starting block this year also. Thank you to the panelists.